Ah, tax season. That time of year, right? And look, whether this is your very first time or you've done this a million times, staring at all that paperwork, yeah, it can feel like a lot.
But I've got some good news for you. It really doesn't have to be that overwhelming. Honestly, getting a grip on the basics is way simpler than you probably think.
Okay, first things first. Pull out your phone or your calendar. The big date you need to remember is July 31st, 2025. That's the deadline for filing taxes on everything you earned between April 2024 and March 2025. You definitely don't want to miss that.
So, in the next few minutes, my goal is simple: to take all that confusion and turn it into real confidence. We're going to get you ready to tackle this head on.
All right, let's start at the beginning, the lingo. Seriously, once you get a handle on just a few key terms, the whole thing starts to make a lot more sense. First up, you'll hear the term financial year, or FY. Just think of this as your earning year. It's the period when you actually made the money. So for this filing, we're talking about everything you earned from April 1st, 2024, all the way to March 31st, 2025. And right after that comes the assessment year, or AY. If the FY was the earning year, think of the AY as the filing and checking year. It's when the government actually looks at or assesses the income you just earned, so it's always the year right after. For the 2024-25 financial year, the assessment year is 2025-26. Simple, right?
And finally, the big one, the income tax return, or ITR. Don't let the name scare you. It's literally just the form you fill out to report your income and taxes to the government. That's it.
Okay, now for what is probably the most important decision you're going to make this tax season. This is the choice that directly decides how much of your hard-earned money stays in your bank account. We've got two different paths you can go down: the old tax regime or the new tax regime. So, which one is right for you? Let's break it down and see what it means for your wallet.
So here they are, side by side. You've got the old regime on one side and the new on the other. Now, your eyes probably go straight to the new regime, right? The tax rates look lower, but hang on, that's not the full picture.
Here's the real trade-off. The old regime has those higher tax rates, yeah, but it lets you claim a whole bunch of deductions to lower your taxable income. We're talking the big ones, like Section 80C for your investments, your house rent allowance, stuff like that. Now, the new regime, which by the way is now the default option, gives you lower rates, but it takes away almost all of those deductions. It does, however, give you a couple of perks. The tax rebate kicks in up to 7 lakhs of income, which is higher, and the standard deduction is also a bit bigger.
So the question you have to ask yourself is this: do all my possible deductions, HRA, home loans, investments, add up? Are they big enough to make sticking with the old regime's higher rates worth it? If you have a lot to claim, the old regime might just save you more money. If not, then the new regime's simplicity and lower rates are probably going to be your best friend. Pro tip: always calculate your tax under both regimes before you decide. Okay, so you've picked your path, old or new. The next crucial step is choosing the right form. And this is important because picking the wrong one is a surefire way to get your return rejected. So let's make sure that doesn't happen.
Let's do a quick rundown of the main ones. For most salaried people with an income under 50 lakhs, you're looking at ITR 1. Easy. Did you sell some stocks or property? Then you've got capital gains, and you'll need ITR 2. If you've got your own business or you're a professional, that's ITR 3. And ITR 4 is for a specific type of business income. Honestly, for most of you watching, ITR 1 is probably going to be your go-to. All right, let's talk about how to avoid some of the most common trip-ups. But instead of thinking of them as mistakes to avoid, let's call this your pro checklist for a super smooth, error-free filing.
Okay, 4 things you absolutely have to do. 1. Verify your data. Go to the tax portal and download your AIS and Form 26AS. This is basically what the government already knows about your income. Make sure it lines up with what you have. 2. Report every single rupee. Yes, even that tiny bit of interest from your savings account. It all counts. 3. List all your active bank accounts. And 4. Listen up, this one is huge. You have to e-verify your return within 30 days of filing it. If you don't, it's like you never filed at all. Seriously.
And hey, remember that July 31st deadline? Well, if you miss it, you could be looking at a penalty of up to 5,000 rupees. That's money you could be spending on literally anything else. It's so easy to avoid.
So, we've gone through the what and the how, but before we wrap up, let's talk about the why. I mean, beyond the fact that you have to, why does filing your ITR actually matter? Well, for one, when you file, you're not alone, not by a long shot. You're joining a movement. For the last assessment year, over 7 crore returns were filed. That number just keeps going up, which is a great sign for the country's economy.
But what about you? What's in it for you personally? The benefits are massive. Your ITR is your official proof of income. Need a loan? Applying for a visa? They're going to ask for it. It's also how you get money back if you've paid too much tax. And maybe most importantly, it creates an official paper trail of your financial life, which is just invaluable.
Here's the best way to think about it. Filing your tax return isn't just a chore. It's your ticket into the formal financial system. It's a statement. It's an act of taking control of your financial life. So there you have it. From understanding the jargon to picking your regime and dodging those common mistakes, you are now totally equipped to do this with confidence. The path is clear, the benefits are huge, so the only question left is, what are you going to do with all this newfound tax confidence?